You're going to call me out on my channel, Joe?
You know what? I'm just trying to tell everybody out there that 15 minutes I think is really valuable.
Hey, Kevin Amolsch, Pine Financial Group, where we work together so you succeed. Hey, you found us. You found us here on Facebook. You found us here on YouTube. Please help me out. We're trying to build a channel, a community to help more real estate investors just like you. You could do that by hitting like, hitting subscribe, and leave me some comments below. We'd love to interact with you. Got another guest with me today, a very special guest, Mr. Joe Massey. Sometimes we get questions about, how do they price mortgages? Like, how do you know what interest rate you're going to get, and why are investors so much more than homeowners? So I brought on the expert. Joe, how's it going, man?
Outstanding, Kevin. I love talking about interest rates. I love talking about loans, and really always appreciate you having me on your channel just to share information with your viewers. And hopefully we'll have some good ideas for you today.
So just in case someone just tripped on this video and they're not actually following us, I know it's weird. That might happen. Tell us who you are and why you're qualified to give us this knowledge that you're about to give us today.
Yeah. So my name is Joe Massey. I'm with Castle & Cook Mortgage. I've been in the mortgage business for 21 years. And what I do is a little different than what you do. Kevin obviously helps you with your fix and flip loans, your development loans, your construction loans, and everything I do is your long-term permanent financing, whether it's for your primary residence, second home in the mountains, a beach property, or maybe an investment property or condos, things like that. So my job is to work with anything you're going to keep in your portfolio for the long term. I've worked with Kevin and your team for more than a decade now, and done a lot of transactions, and so hopefully qualified to give you some ideas about residential mortgages.
Yeah, and with mortgage rates being a little higher now than they have been in the past, we're starting to see more and more questions. You probably get even more than we do. But I want to ask you some questions about risk-based pricing.
Sure.
So how does a lender price a loan? When I say price, mostly what I'm talking about is the interest rate. I know there's different discounts and things that you can manipulate that a little bit. And if you'd like to share some of that with us, but I'm really concerned with, like, how do you know what interest rate one person gets and why is it different from somebody else?
Yeah, that's such a great question. There's a ton of variables that go into it, but let's just start and say today's average interest rate is 7.5%. All right. That's just the average. And now you call me, Kevin, and you say, you know what, Joe, I want to buy a primary residence and I want to put 5% down. Okay, no problem. Now you're putting a little bit less money down, meaning there's higher risk. If you don't make your payments, we may lose money if we have to foreclose on that. So how do lenders make up for that risk? We have to charge you a little bit of a higher interest rate because you're putting less money down. So maybe today's average is 7.5%. and you want to put only 5% down. So maybe you qualify for a rate of 7.75. And then as I go through the conversation with you, you say, you know what, Joe, I've got lower than average credit. So maybe your credit is a 680 or a 660 credit score. Well, that doesn't mean we can't help you. It just means that you're a little bit higher risk. So how do we offset that risk? Again, a slightly higher interest rate. So maybe instead of 7.75, maybe you qualify for a rate of 8% or 8.1. But you might say, you know, Joe, I don't want an interest rate of 8.1. I want to pay some points. Can I buy down my interest rate? Sure. You can actually spend higher closing costs to buy back down to that lower interest rate. So there's several levers and variables that you can use based on your individual situation. Now, where it kind of gets complicated is maybe you call me, you have great credit, you're putting 25% down, you qualify for a below average interest rate. And you're telling your buddies, you're like, oh my God, I love Joe. He got me a rate of 7.3 while today's interest rate is 7.5. And then your buddy calls me and I go through their information and they've got lower than average credit. And maybe they're financing an investment property, which is more risky, right? Because there's no emotional tie to that. And maybe it's a condo. So we've also got a homeowners association, which impacts the risk. And they qualify for, let's just say, a rate of 8.375. And I go through that with them and they're like, you know, Kevin got 7.375. How come you're giving me 8.375? Well, that's a really fair question and super reasonable. But the reason is risk-based pricing, which you alluded to earlier. Every loan has a different interest rate and different points depending on the risks associated with that particular transaction.
Yeah, so things like a duplex is higher risk than a single family, right? And a fourplex might be higher than. So why? Well, you kind of already alluded to it, but an investment loan. This is a question I get: why is investments more expensive? So
Yeah.
risk-based pricing. It's more. So tell me, like, why is it riskier to own an investment property, and what kind of a difference do you think you normally see?
Yeah. So the difference between a primary residence and an investment is about 0.75% in the interest rate. And the real reason is that emotional connection. So if you're financing your primary residence, you're going to do just about anything possible to make that payment. If you lose your job, you're going to start driving for Lyft. If you get your hours cut, you're going to start driving for Uber. You're going to start doing DoorDash. You're going to find a way to pay that payment because you don't want to be kicked out of your house and you don't want your family kicked out of your house. Whereas an investment property, there's no emotional connection. You lose your job, you're going to find a way to pay the primary residence. But if that investor, somebody moves out of the property, that property has a major amount of damage, some sort of problem, there's no emotional connection there. And they might say, you know what, this property's lost a ton of value. We're upside down on it. We just want to wash our hands and just mail the keys back to the bank or go through foreclosure. So that emotional tie really improves interest rates for a primary residence versus an investor where it's really just a business decision.
Yeah, and I've seen some of these studies, like these guys know what they're doing. So
Yeah.
when they know the default rates of primary compared to investor, compared to second home, based on this down payment and this credit. I mean, they've got this dialed in. So they know that like you're saying, the 0.75%, that's where they're still profitable, knowing they're going to have more defaults.
That's right.
I think you explained it really well. Is there anything else like that? Let's talk about that discount. You mentioned that quickly, but like if I pay 1 point in discount, let's say, what's that going to do for my rate?
Yeah, so 1 point in discount generally, and this is where it's tricky, and this could be different on the day this is being aired, but 1% in discount would be 1% of the loan. So if it's a $500,000 loan, you're spending $5,000 in additional closing costs. That will usually reduce your interest rate by about 0.3%. So if you were at a rate of 8% with 0 points, for example, you might decide to pay 1 point, and that's going to lower your rate to maybe 7.625. Now, if you decided to pay 2 points, that might lower your interest rate to 7.25. But it's not necessarily a linear relationship. Sometimes people call me, they're like, Joe, I want to pay 10 discount points and I want a rate of 4%. And it doesn't exactly work that way, right? As you get lower and lower in interest rate, your points go higher and higher. So it's something that we look at with every client, depending on how much you're putting down, how much disposable cash, and maybe how much the seller is contributing towards your closing costs. It might make sense to pay more discount points to get down to a lower interest rate. Or on the flip side, sometimes I meet clients and they say, you know what, Joe, I do want a 30-year fix, but I'm only going to keep this property for 18 months because we're rezoning it and then we're going to sell it for development. So I want to have 0 points and maybe an 8 or an 8.25% rate because I want to keep my cash out of pocket as low as possible. And I'm comfortable making a little bit of a higher payment because I know I'm not going to have this property for very long. So that's a conversation we have with every single client. What's your long and short-term goals with this property? How much cash do you want to invest? How much disposable cash? And how much is the seller contributing? Because there's not a one size fits all. It is not, as much as I love the Super Bowl commercials, it is not push button, get mortgage. You really want to make sure you've got myself or a guy like Kevin or somebody else on your team that's looking at all the options with you to make sure you're picking the best possible scenario for your long, medium, and short-term goals.
And I've done a bunch of loans with you. I don't even know how many, but I know every single time we have that conversation, like what's the break even if I pay this point or these 2 points? Is it 24 months, 36, 40, like how long until I make my money back? And is that worth it? Especially at a time like this when rates are high, we're likely going to be out of that loan sooner than we're going to be out of the property, right? Because we're going to be refinancing it. So we got to, it's a crystal ball again, like when are we going to be refinancing it? But gosh, there's a lot to go through when you're analyzing the numbers on a mortgage, and someone like you on the team is, gosh, it's invaluable.
Yeah, well, thank you. And it's funny. You and I have done a lot of loans together, and every time I'm like, okay, Kevin, I need 15 minutes on a Zoom call because we're going to go through option A, B, C. And you always tell me, you're like, well, just which one's the best one? I'm like, I don't know. I'm not the one that's going to be writing the check for the next 30 years. So you have to get on a call with me. We've got to go through it. I'll lay out the pros and cons for each one, and you roll your eyes at me every time. But you know what? At the end of that 15-minute meeting, you and I feel really good that you've picked the loan that makes sense for you. And then we move forward and make sure that you've got the right loan with certainty. So I appreciate that you'll even let me take you through our process or take you through the process every time. So thank you for that.
You're going to call me out on my channel, Joe?
You know what? I'm just trying to tell everybody out there that 15 minutes I think is really valuable, especially maybe you're a first-time home buyer and you're not sure. We might spend an hour together. That's okay. We want to go through everything because I tell every client the same thing. For the next 30 years, Mr. and Mrs. Client, you're going to get the bill in the mail, not me. It's the same amount of paperwork for me, regardless of which transaction you pick. I want to make sure it's the transaction you're really happy with.
Love it. Cool, man. So how do we get a hold of you?
Yeah, so you can reach out to me directly via phone, 303-809-7769. Or, of course, you can email me, jmassey@castlecookmortgage.com. Or my favorite, put a comment down below. Kevin and I love interacting on these channels. Put a comment, like, subscribe. Make sure you're reaching out to Kevin for your fix and flip loans. Make sure you're calling me for all of your permanent financing. And if you disagree with any of this, we'd love to hear that too. Sometimes those are some of our best conversations. So anything we can do to support you, please feel free to reach out anytime.
Yeah, totally agree. And so if you want any help from Pine Financial, you probably know where to find us. If not, it's pinefinancialgroup.com. Thanks, Joe.
Thank you.